And look, the Fed just nuked your $250,000 home sale tax break. Not with a law, not with a vote, not with anyone in Washington saying a single word about it. Right now, Trump's Treasury Department is scrambling to figure out what to do about it. Senators on one side, lawyers on the other, and the White House waiting to see who blinks. You're going to want to know what they decide, but more so, you want to know what to do before they decide, because the math has already shifted on you, quietly, without your consent. This keeps happening, despite you playing by the rules. I mean, if you paid off the mortgage, you raised the kids, you did everything they told you, the deal you were promised back in 1997 isn't the deal you're going to get when you finally sell. You did your part. Something else failed. So I'm going to show you 4 things. What actually happened to your $250,000 tax break, 3 other places this exact same game is running on you right now, what Trump's Treasury is trying to do about it, and 3 ways you can maneuver around it while Washington argues with itself to protect what you've built. Let's start with the Taxpayer Relief Act, passed in 1997. What this says is when you sell your primary residence, you can exclude a portion of your profits from being taxed. $250,000 for a single filer, $500,000 for a couple. At the time, that was a real promise. 29 years later, half that promise has turned to dust. And here's how. Cumulative inflation from 1997 to 2026, running the official CPI numbers from the Bureau of Labor Statistics, comes out to about 106%. The dollar has lost just over half its purchasing power since the day that promise was made. Here, walk it through with me. If Congress had indexed the cap to inflation the way they index Social Security benefits, that $250,000 break for a single filer would be sitting at $514,350 today. Married couples would be looking at $1 million IRS shield. Instead, it's still at $250,000. And in real 1997 dollars, what it actually buys you today, that's $121,500. Half your tax-free shield is gone. And nobody in Washington had to take a vote, write a bill, or face a single hostile question on cable news. The Fed printed the dollars the rule was written in, and time did the rest. And this reaches far beyond a handful of millionaire homeowners. A housing market analysis cited by CNBC in March of this year puts the number at 29 million American homeowners, roughly 1 in 3, on track to exceed the $250,000 single filer cap when they sell. Another 8 million couples on track to exceed the $500,000 married cap. This isn't an edge case. This is 1 in 3 homeowners. Take a married couple in San Jose, bought a 1,400 square foot ranch-style home in 1992 for $280,000. Paid off the mortgage. Today, the place appraises at $1.8 million. They figure they'll sell, move to Idaho, live off the proceeds. Their accountant runs the numbers. Documented capital improvements bring their basis to $375,000. Taxable gain after the $500,000 married exclusion, $625,000. Federal capital gains at 20%, $125,000. California state tax at the top bracket, $58,000. Total tax bill on a so-called tax-free home sale, $183,000. And there's more to pay, which I'll get to in a second. But the point here is, that's not a windfall. Those are inflation-created gains where the IRS is standing by to take their inflated cut, to recoup years of tax savings gifted to sellers. See, there is no such thing as a free lunch. I mean, they told you it was free, but now they're here to collect. And here's the part almost nobody warns surviving spouses about. I didn't even know this until digging into this story. If you're a surviving spouse, or if you know one, this is critical. The doubled $500,000 exclusion is available to you, but only for 2 years after your partner dies. After year 2, you're reclassified as a single filer with a $250,000 cap. The realtor doesn't mention it. The financial advisor misses it. I've never heard anyone on TV say it, and I pay attention to this stuff. By the time the fog clears and the decisions get made, the doubled cap is gone, and the difference is tens of thousands of dollars due to Uncle Sam. People are starting to notice, though. Even a couple of senators are taking this stealth tax seriously, of which I'll get to what these 2 heroes in DC are doing for you right now in just a second. Because this all goes well beyond your home. The same trick, freeze a number while inflation eats it, it's running in at least 3 other places in your life right now. The same villain, the same victims. Number 1, your Social Security. If your retirement income, pension, IRA, part-time work, totals less than $25,000 a year as a single retiree or $32,000 as a couple, your Social Security check is fully tax-free. That was the deal Congress promised in 1983. Cross those thresholds and the IRS starts taxing the check itself, up to 85% of it. Those thresholds have never moved. Same trick as your $250,000 home break. If Congress had indexed those thresholds to inflation, the single filer tax-free threshold would be $82,750 today. The couple threshold would be $105,920. Instead, there's still $25,000 and $32,000. The government promised it wouldn't tax your Social Security below those numbers, but then inflation broke the promise. And it doesn't stop at retirement income either. Number 2, the alternative minimum tax. This is the one that proves the pattern is real. The AMT is a second tax calculation. The IRS runs your taxes the normal way, then they run them again under AMT rules, and you pay whichever is higher. It was created in 1969 to catch 155 specific ultra-wealthy taxpayers who were legally paying zero federal income tax through stacked deductions. Congress forgot to index this one also. By 2012, the AMT was on track to hit 27 million middle-class families. A tax designed for 155 rich guys was about to land on every dentist, school teacher, and small business owner in the country. Congress finally indexed it in 2013, 44 years later. That's the answer to how long this game can run before they fix it. Your $250,000 home break is only 29 years in. But wait, there's more. Number 3, the second under-the-radar tax that happens when you sell. Let's look at our San Jose couple again and watch this closely, because you start to see where this tax the rich idea always ends up ambushing the middle class at some point. You see, in 2013, Congress added a second tax, the net investment income tax. It's an extra 3.8% on top of your regular capital gains tax. You pay it if your income for the year crosses $250,000 as a couple or $200,000 as a single filer. In 2013, those thresholds represented the wealthy. Households earning $250,000 a year, every year. Got to make sure they pay their fair share, right? Well, again, those thresholds have never moved. Same game. If indexed today, that $250,000 couple threshold would be $354,000. Instead, still at $250,000. But wait, you say.
I've never made $250,000 in a year.
Don't worry, they already thought about you. When you sell a home, the gain itself counts as income that year. So our San Jose couple, pension and Social Security never came close to $250,000, suddenly looks wealthy to the IRS in the 1 year they sell. So the $625,000 gain blows past that threshold. They owe an extra 3.8%, roughly another $17,000 on top of the $183,000 we already calculated. A tax originally sold as a tax on the wealthy, now layered right on top of the home sale tax it was never meant to touch. And I could go on showing you this pattern with the SALT deduction cap, federal minimum wage, and there's more, I'm sure, if I kept digging, but you get the pattern, right? You see it? When these thresholds are set, inflation catches up or gobbles them up. That's what's so insidious about inflation. It doesn't just erode the dollar in your pocket, the money in your savings account. It erodes every promise the government made you, every benefit, every deduction, every protection, every wage floor, without anyone in Washington ever having to be the one who took it away. It attacks from every angle at once. It's a slow-burning nuke exploding in the lap of your well-being. And the only fix Congress has ever offered after the damage is done is to update the number 44 years later and call it a win. Which brings me back to those two hero senators in D.C. right now fighting the good fight. In early March of this year, Senators Ted Cruz of Texas and Tim Scott of South Carolina sent a letter directly to Treasury Secretary Scott Bessent. The ask is simple. Use executive authority without going through Congress to administratively redefine cost basis to mean inflation-adjusted cost basis. Stop the silent tax. Restore the original 1997 promise in real money. And there's even a bigger version of the ask floating in some Trump-aligned circles too. Eliminate capital gains tax on primary home sales altogether. But here's the catch. The Department of Justice has held for nearly 35 years, in a formal Office of Legal Counsel opinion, that the Treasury Department does not have the legal authority to do this without an act of Congress. George H.W. Bush considered the exact same executive move in 1992. His own DOJ told him no. Cruz pushed Steve Mnuchin to try it in 2019. Mnuchin declined. So this round, Bessent's team is scrambling, looking at whether there's a legal pathway the previous administrations missed. The senators are pushing. The Office of Legal Counsel is the obstacle. Will anything actually move before the next election cycle? I don't know. I mean, we're going to have to wait and see. But if history continues to repeat itself, even if the Treasury finds a way through, it's going to get challenged in court within hours. And even if it survives the courts, the next administration can reverse it with the memo. The 29-year-old math problem doesn't get fixed by one administration. It gets fixed when Congress decides, and they've been sitting on it for decades. The reason why, like so many other things that go on in Washington, it's a mystery. So here's what you can do in the meantime, because there are a few things. Now, none of what I'm about to walk you through is tax evasion. The tax code is the tax code. You pay what you owe. But there's a wide difference between paying what you owe and overpaying because you didn't know the rules. Some people will hear these strategies and call them clever. Some will call them unreasonable. Some will call them cheating. Well, they're none of those things. They're written into the same tax code Washington has been arguing about for decades and counting. Anyone can use them. Most homeowners just don't know they exist. So strategy 1, build your basis file. The home sale exclusion protects the gain, but what counts as gain depends on what you can document. Here's how it works. Your taxable gain is what you sold the house for, minus what you paid for it, minus every capital improvement you've made over the years. New roof, kitchen remodel, HVAC, addition, solar, foundation work, every dollar of documented improvement is a dollar that doesn't get taxed. Most homeowners can't produce a single receipt for the kitchen remodel they did in 2011. So when they sell, their accountant has to work with the lowest defensible basis, and the IRS gets the maximum possible bite. Take our San Jose couple. Their accountant put their basis at $375,000. But what if they could prove another $100,000 in improvements they've actually made over the 30 years and never bothered to track? That's $100,000 that comes straight off the taxable gain. So get a manila folder, label it House Basis File. Pull the closing statement from when you bought the place, then dig. Look through your bank statements, old credit card records, contractor invoices, permits that you've pulled with the county, anything that shows you put money into the structure itself. IRS Publication 523 spells out what counts. The IRS taxes the gain you can't document, so document everything. Strategy 2, convert it to a rental, then 1031 it. This one is a little more involved and requires some planning ahead of time, but for the right homeowner, it can wipe out the entire federal tax bill on the sale. Here's the concept. The home sale exclusion requires you to have lived in the home as your primary residence for 2 of the last 5 years before sale. Notice what's not in there. It does not say you have to be living there on the day you sell. So here's the play. You move out. You convert the old home from a primary residence to a rental property. You rent it out for a year, maybe 2. Then, while you're still inside the 3-year window from when you moved out, you sell it as an investment property. Watch what happens. Because the home was your primary residence 2 of the last 5 years, you still get the full $500,000 married exclusion. And because at the moment of sale, it's now an investment property, you can do something called a 1031 exchange on the leftover gain, rolling those proceeds into another investment property and deferring the federal tax on it, potentially forever. Strategy 3, buy, borrow, die. Basically, don't sell, ever. It's the wealthiest 1%'s favorite strategy. 3 steps. Step 1, you buy appreciating assets. Real estate, stocks, businesses, things that go up over time because of inflation. Step 2, when you need cash, you don't sell. You borrow against the equity. A HELOC on the house, cash out refi, securities backed line of credit. You can even borrow on your crypto right now on many of the consumer platforms. The key here, and this is the whole trick, is that the IRS does not tax borrowed money. Loans aren't income. You live off the borrowed money tax-free. Step 3, you die holding the assets. Under IRC Section 1014, the step-up basis rule, your heirs inherit those assets at fair market value as of the date you die. Decades of accumulated capital gains get wiped out in a single afternoon. Now, I'm just a U.S. Marine who buys houses for a living, who's seen and done a lot of what I'm sharing with you. But don't make any moves here based exclusively on what I said. Consult with a tax strategy lawyer or a CPA before making any of these moves. And you can get the best of both worlds at protectwhatsmine.com. That's who I use for all of my big moves like this. And look, once you train your eye on this trick, you start seeing it everywhere. The IRS isn't the only place where the rules got written for somebody other than you. Take Medicare. If you're 65 or you're staring it down, you probably figure Medicare is some friendly government safety net that's just gonna take care of you when the time comes. It's not. Same kind of system, same kind of game, just bigger, and a whole lot more confusing. And those daytime TV ads telling you they'll help you pick a Medicare plan, those folks aren't your financial advisor. No, they're commissioned brokers. Some of them earn substantially more on one plan than another, which has a funny way of shaping the advice you get. Pick the wrong one, and you might not be able to switch back. That's why I pulled this video right here out for you to watch next. Same trick, eerily similar feel. with a lot more landmines, but most of them are avoidable if you know they're there and you know what to look for. So watch this one next. God loves you, and so do I. Take care.